the simulator can go through a 50% drawdown like nothing. But most traders, if they experience that similar drawdown, they're going to lose faith in the strategy. They're going to lose confidence in themselves. They'll have outside voices telling them, to stop or to interject something. They won't continue along the path that they had started.
All right, ladies and gentlemen, welcome back to the SimCast. This is episode 16. I got my buddy Sam, aka Samwise from the UK. He's still got that shiner from his rugby match.
Looking good.
Looking good. And I've got another bearded brother with us today. Really excited about this. I've been anticipating this interview with the one and the only Kris Verma. Welcome, Kris.
Oh, thanks, guys. Appreciate it.
Nice, man. Yeah, and definitely looking good on that beard. I like that, bro.
I like yours, John. You've got
I got the handles going.
You got some handles growing. Yeah, it looks nice.
Bro. I like it, man. You got to do some work on yours over there.
Man, I'm trying. I'm lagging behind you too. I feel ashamed.
All right. Well, listen. Let's jump in here with a little background info. So, I know a little bit about you, Kris. You're very active on Twitter. But for our viewers out there that may not know you, tell us a little bit about your background, maybe, pharmacy and some of your science background, how you got into trading.
Right, for sure. So I was like a pharmacist for about 10 years before I transitioned into trading. And, it's a bit of a unusual transition of careers, but it all started from my first year pharmacy classwork where we had to take statistics and probabilities. And that's where I kind of fell in love with the numbers game, mathematics, and I was also doing a little bit of sports betting on the side. So that kind of just fueled my hunger for that industry. And it was actually my professor in that class who was an avid sports bettor. So he would always bring practical examples to the classroom of how, NFL point spreads would work and how probabilities would impact the odds and all of these things, psychology of betting. And that's how I kind of transitioned into sports betting. I did that for about 10 years. And then I think, once COVID hit, the sports industry kind of slowed down. There weren't as many games. And also over the years, the sports books got more and more efficient. So it became very difficult to find an edge. So I found that my edges were diminishing, my returns were diminishing, and I had to branch out to a different field to continue making, decent returns. And that's where trading came into play.
Cool. So, it was probably just something that you thought was a logical next step. I mean, everybody understands there's a stock market out there, but it wasn't like, hey, man, you need to get in here and do some trading. It was more like, maybe I could exploit this thing.
Right, exactly. And I had a few friends who were already trading and they were already successful. So I could see that it could be done. They were more long bias traders for large caps, but I could just see that they had a consistent mathematics-based process and it just continued to work. So when I jumped into trading, I tried to find edges by backtesting certain ideas. And really the only thing that I was able to find was small cap edges to the short side. Nothing else was consistent enough and nothing else was really producing enough returns to make it worth the risk. So that's where I kind of focused my attention on.
Interesting. Well,
go ahead. Impressive. So you very quickly identified what your niche was going to be. And then since then, it's just been about focus and honing that, I'd imagine then, because that what I see by Twitter, that's very much what you're still doing to this day.
Right, 100%. So when I became successful as a trader, it was specifically on shorting small caps. And my approach hasn't really changed. And even with the slow market conditions, like a lot of people are telling me I should branch out, trade large caps, trade this and that. And my only concern is that I don't have data on those things. I don't have conviction in that. So if I'm in a trade that's going against me, how do I have the conviction to stick with that? I don't have that same level of confidence that I do with small caps. So I'd rather stick to what I know. And if there's no plays, then I'm okay being patient. I'll just wait. I think a lot of traders are over trading or trading setups they're not really comfortable with to make up for the lack of plays. That's not something that I'm willing to consider.
So kind of going back then to your start, how many years ago was that?
As a trader?
Yeah.
I began looking into trading around 2017.
2017. Yeah. How long would you say it took you to back test? And like, what were you using back then to generate that data?
Well, when I first started, I was pretty new and green to the industry. I didn't know all of the software providers, all of like Polygon and things that I use now. So in the beginning, I was just using Trade Ideas. So they have like basic 3-month backtesting services that you can use. And that just helped give me an idea of what possibly could work. So when I first jumped into trading, I was actually a long bias trader. I basically was doing the exact opposite of what I do now. I was buying stocks that were crashing really hard for a bottom bounce. It was basically a short-term reversal. And it did work. There was an edge. The only issue I had with that strategy was there weren't many plays. You get maybe 1 or 2 plays a week. And the liquidity was very low. Like the majority of these stocks would have less than 1 or 2 million shares traded in the entire day. So it wasn't as scalable. So when I looked at the opposite, basically shorting extension, there was way more plays, way more liquidity, because it's natural for people to chase stocks going up, right? Everybody, when they go into the trading day, they look at the top gainers of the day, the gappers, not the down gappers, right? So that's where the volume and the liquidity was. So once I transitioned to that, my bankroll just exploded. And here we are a few years later.
So in 2017, then that's kind of when you started. I'm curious, when did you really find your edge? Did you start trading before that, or did you just wait until you saw, hey, I've got something I can exploit here? And then you started putting that capital to work with some of the systems that you'll share later?
Well, when I first started trading, I made a bit of a mistake of assuming it would be very similar to sports. I thought the transition would be very easy because it was all math and numbers. But what I failed to really appreciate is the ability to self-sabotage when you're a trader. When you're in a trade, you have the ability to add, to subtract, to hold past certain levels. Whereas if you have a bet on a game, it's largely out of your control. So a lot of those skills that you need to learn about emotional control, discipline, position management, you don't learn as a sports bettor. And those are the things that cost me initially. And I'd blown up a few accounts as a beginner trader because I didn't have those emotional, discipline, tactics in place. So it took me a few years of trial and error before I was able to really hone in my skills. And it was 2019 is when I turned the corner and became very profitable.
So what happened in 2019 was that, do you just think you reached some sort of like trading emotional maturity, or was it something else?
Yeah, I think that's like a really good way of putting it. I just had reached a level of experience, awareness, maturity, as you say, where I just knew what worked and what doesn't work, because what doesn't work is what I've been doing for the past 2 years. And I wasn't being rewarded with, reckless trading, over leveraging, bag holding, all of the typical mistakes that we make as traders because they're all emotional, right? So once I was able to control my emotions and detach from monetary goals and focus on the execution aspect more, that's when my bankroll really exploded. Because when I was looking at my projections and my historical databases, my system was always making money, but I wasn't. So I was like, what is the disconnect here? Why am I not making money, but my system is consistently green? And it was always that emotional issue that I had with the loss. Like if I was in the losing trade, I would fight it. I would average the loss. I would hold past my stop, whereas the system would be cutting it, right? Be minimizing the damage, whereas my one loss would wipe out my whole account. So those were the issues that I had to overcome. And I think a lot of traders suffer from these same kind of, pitfalls.
Absolutely. Because I always think, like, I'm using myself as an example, like it's very easy we always take max size losers. It's very rare that we go, I'm going to cut early. But at the same time, though, when you see your profit massively in the green, there might be actually no signal for you to cover or to sell, but you just like, I've made too much money. I've got to take some profit. And I think that's probably the Achilles heel of many traders.
Yeah, I agree 100%. I think it's human nature that we want to take profits quickly because it feels good, and we don't want to risk losing our gains. Whereas a losing trade will be extremely patient with it, because we're always of the mindset that it's going to turn around, it's going to work, it's going to come back in our favor, because we always feel like we're right. right? We have built-in biases that we always feel like our idea is correct and our thesis is correct of the trade. And we're very unwilling to accept the fact that we could be wrong. I think it's just human nature and to some degree a part of the male ego. So these are issues that we have to overcome and deal with and detach from as much as you can.
To that point, Kris, do you feel like it was it more ego? Like if you had to like ascribe some kind of percentage to ego versus like maybe trusting the back tested system that you had?
I think this is a very personal question. Like you'll have some traders who are, very large egos. You'll see other traders who have very small egos. Like in my presentations, I like to classify traders as either conservative or gunslingers. And I know myself, I'm very much to the gunslinger type, right? I'm very aggressive. I'm very, throwing money around, always thinking that you're right, you're going to hit home runs, this and that. And I see other tendencies and other behaviors in my students that fall towards the conservative side. And this really opened my eyes because I never knew this type of trader existed. I thought everyone was like me. We're just max leverage, max size on every trade, just hammering in everything because it's going to work, right? Because I'm correct. It's going to go my way. But we have to be humbled so many times by the markets to realize that the markets don't care what we think, right? So it depends on your personality type. And this is something that I touch on in my webinars, that you need to identify what kind of trader you are. You need to identify your trader personality. So that way you can tailor your approach to your personality. So I know myself, I need to be extra disciplined and extra hard on myself because it's easy for my ego to run out of control, right? And to take over my trading. Whereas other traders, they shy away from trades. They're fearful of taking trades because they lack that confidence. So those guys need an extra boost, right? They need an extra, push, to get into a trade. So that's why over this past month or so, I've been extremely disciplined because I know one rule break for myself will result in subsequent rule breaks with a lower threshold. Once you've reached that threshold, it's so much easier to break rules again and again. So for me, one rule break is the equivalent of 100. I want to avoid that first rule break, so I'm always in control and composure of myself.
That's awesome. No, that's what the reason why I was smiling so big there when you said that some people just want to go all in. Like, I'm like Jesse Livermore. I'm like the boy plunger. Like, give me 4x leverage, and as soon as I see my entry signal, I'm all in.
Yeah.
But Sam was you and I were talking kind of offline just a little bit there about like that scientific approach that you take. Do you think does that lend sort of because if you're just 100% discretionary, and I'm trying to think of like new traders here, like retail traders that are just coming in, maybe following a guru here or a guru there, they're bouncing around a little bit. Do they really have the confidence to trade if they haven't tested something until they're blue in the face like you have? And to know, for example, what your probabilities are, what your Kelly criteria are, whatever else.
Exactly. That's a good point, actually. I think a lot of discretionary traders will lack conviction when things are going against them during drawdowns, right? Because how can you have conviction in something that's not tested or proven or quantified? You don't know at what point, okay, do we need to relook at things? Do we need to tweak things because the numbers are way off? So when we're in a drawdown or one of my systems is underperforming, it's so easy for me to see, all right, this is the baseline expectation of this strategy. And right now we're underperforming, by 10% over a period of 100 trades. To me, that's like a 5-star alarm. There's something going on here. But if you're a discretionary trader, you're probably just going to rationalize or make some sort of excuse or anything that will appease your mind as to why things aren't performing well. When you're quantifying it, it's so hard to ignore those red flags because it's staring you right in the face. And it also gives you more conviction when you have that database backing you up. I've always had the theory that successful discretionary traders are actually very systematic. They just don't quantify things or put it into terms. Like they may be able to recognize patterns in their mind, in their brain, and reproduce that in their trading. But to be able to teach that is very difficult because it's largely subconscious. That's just my personal theory.
No, I think because I've listened to quite a few podcasts, and that seems to be quite a theme with perhaps traders as they start going into their second, third decade, that they may have been the crazy scientist, but actually slowly they've just evolved into just some sort of free-flowing trader. But actually, I think they've just got such a database in their head that actually they are just as systematic as they were probably 20, 30 years prior, whatever it is. It just happens that it's evolved slightly. So yeah, I see what you're saying there.
That's awesome, man. Yeah, it's something that that I think could possibly lend itself to expediting the learning curve. Would you agree with that? Like being a back tester, like data driven in the very beginning, because as you and Sam were saying, it takes a lot of time to build that database in your mind if you're not doing that. Like you have to have so much screen time, et cetera, et cetera. Would you agree?
I agree 100%, John, because as a educator in the trading community, I've seen all kinds of students come into my realm. And I've seen students who have zero trading experience have success off of day one, right from the start, just by using our strategies. And they're 100% data-backed strategies. There's no discretionary components involved. And the reason being is because you have such conviction given to you already. It's almost like you have 10 years of experience just injected into your brain already, just by following certain, entry and exit criteria, certain position percentages. Everything is laid out so easily for you that once you have a few weeks or months of success, that builds the level of confidence that you need. Whereas if you take a discretionary approach, you may not be able to emulate that as consistently.
Right.
Those that are successful from day one, emotionally, how are they so mature straight away? Because I'd imagine that if they're about to win a few thousand on their first trade, I don't know, I'm thinking they must be jumping around their lounge, jumping off the sofa, the study, whatever, thinking hallelujah. How are they this is from someone who I'm very immature, so I'd love to hear.
Well, I would say that example that I pointed out is probably the minority of people. Most traders who come into the market, they allow the wins and the losses to affect themselves too much, right? They're too high on their wins and they're too low on their losses. If you're able to detach from the money, then you'll have more success. And that's where I find those students are able to do better. Those are the ones that are sizing in less. See, this is the common mistake that I find with a lot of traders is that they come in with, let's say, a $10,000 account, right? That's a typical sized account. They're probably under PDT. So their idea is, let me get over PDT as fast as I can. So they're leveraging in, going all in with their account, even more than 100%, going above the percentages that we recommend based on our simulations. See, my Kelly stake, if you guys aren't familiar with the Kelly Criterion, it's a position sizing calculation that ideally calculates the optimal position size. So when we have these simulations that we run, we usually go with like 50% or half Kelly, which is fairly aggressive. But I've had students going with, 1 Kelly or 0.75 Kelly. And when they have exponential bankroll growth off the bat, they're elated, right? They're excited, they're euphoric, but they don't appreciate the potential drawdown with such an aggressive Kelly stake. And this is something we'll go over later in this podcast. I'll show you guys a few slides of what I'm talking about, but they just don't appreciate the volatility of the P&L swings and the emotions that are attached to that. If you're a robot, you can easily do this, right? If we look at the simulations, the simulator can go through a 50% drawdown like nothing. But most traders, if they experience that similar drawdown, they're going to lose faith in the strategy. They're going to lose confidence in themselves. They'll have outside voices telling them, to stop or to interject something. They won't continue along the path that they had started. So it's very difficult for new traders to have that growth and be consistent with it because they don't have the emotional aspect down.
What I'm interested in knowing too is like, and before we get into, I want to ask you about one trade that you posted back in September. But before I do, how would you explain to a new trader how to observe the market, like, and find an edge, like, because you have so many traders coming in? Did you start off with, say, like observing some of the guys on Twitter, or, like seeing that, or did you just look at enough charts and you say, okay, that looks like it gaps up a lot and then craps a lot, or that looks like it gaps and then runs 100%? Like, how do you say, like, hey, here's an edge, like, let me study this, how many times this has happened, or something like that?
Oh, that's a really good question, John. And this is exactly why I started trading, is because I was able to determine edges mathematically before I placed my first trade. Like, I was still 100% on board with my sports betting at the time. And it was one of my friends who convinced me to transition over because he had success. So what I did is, like I said, I used the trade ideas back testing. And when I plugged in the numbers in my database, like, you can export the information into Excel. And once I was able to put that into my formulas and my templates, and we'll give you guys, viewers here, a sample template that I use all the time, and we'll show you guys how to use it as well. When I was able to find edges in that data, that's what gave me conviction. It actually got me really excited, because the edges that I found, John, were better than anything I had seen in the sports betting world.
But going back to, like, maybe before you put that into Excel or you went to trade ideas, how did you know to say, I want to input this criteria into the back tester? Was it something that you just observed on the chart, or were you just looking for maybe, saying, like, okay, the biggest bang for the buck, I want the biggest volatility, like, what's going on in the market to bring me the biggest volatility every day? Was that kind of what you were looking for, or is that what new traders should look for?
Right. So this is a part that I didn't include. It took many hours, many days, and sleepless nights of trying to find a strategy that produced an edge. If anyone has used trade ideas, they have a trade ideas back testing component where you can enter in your criteria and all of the the fundamentals that you want. And this probably took several months of tweaking and playing with. But the only thing that I found a significant edge was in reversals of very extreme movements, either to the upside or to the downside. So like I mentioned, when I first started, I wanted to buy stocks because I didn't even know what short selling was. I had an interactive brokers account. They never had shares available to short. I didn't know what a locate was or anything. So I just basically bought stocks that were selling off extremely fast because I saw from the back testing that they had a high probability of a reversal, right? And that was a profitable strategy with an edge. But like I mentioned, there wasn't any liquidity. So I thought to myself, what if I do this in reverse and I short sell the same thing, the exact same criteria, like a stock is going up 15% in under 15 minutes, right? And that same criteria is what I use to this day, right? So if the stock is going up too fast, too quickly, there's a high probability that it's going to come down. So if we short it with a predetermined stop loss, with predetermined position sizing, what edge can we expect over time, and what return can we expect over time? So when I was able to quantify these edges, it gave me the conviction to put real money on the trades.
That's awesome. Yeah. So it sounds like it takes a little bit of both, time, observation, tweaking data, plugging things in, seeing what might happen here. If I change this variable, that sort of thing.
Yeah.
Cool, man. All right. So I got to ask this question. All right. I'm going to share my screen here, and I got to take you back.
Bring it on.
All right. I got to take you back to September here.
Okay.
I think it was September 21st. So can you see the screen?
Yeah, I got it. NNVC. I remember this.
All right, cool. So you shared this trade on Twitter. So I figure it's fair game. It's public knowledge here. But you did. I noticed that you got a lot of hate mail, as it were, for this trade here. Can you talk us through what was going on while you were in this trade, and then maybe use this to kind of segue into your actual strategy so that we understand your mindset here?
Okay. So the reason that I post these kinds of charts is to bring awareness to what we do and what our strategy is. So this right here is basically an outlier. If we place, like I say in the commentary, if we place this identical trade 100 times, the expectancy is positive. But people only focus on the rare outliers that go against us, right? The majority of the time, if we take this exact trade, it's going to be a gain, right? It's not going to spike against us, whatever percentage this was. So a lot of people are of the idea that you need to stop out quickly, right? You need to have positive profit ratios. You need to have 2-to-1 risk reward, just because it's common trading wisdom that's just genuinely accepted, right? But when I came into trading, and I just think as, you know, as a contrarian trader, I'm always going against the grain, right? I'm always questioning the status quo. So when I look at a chart like this, I just want to know, all right, what's the expectancy over 100 trades, 1,000 trades, not just one outlier example that was going against us. So as you guys know, I use wider stops than, you know, commonly accepted in the trading community. And because of that, I was able to avoid a loss on this trade. Now, some people say that this is reckless, this is poor risk management, you're going to blow up your account, but everything in this chart is predetermined before I enter. I understand and accept the probability that this can and will occur. And from the large sample backtesting, from the data that we have, I'm able to determine the correct stop loss, the correct Kelly percentage to use on this trade, such that I still maintain my edge and my high win probability, given the fact that a 20 to 30 to 40% stop may occur as well. So every single possibility is factored into these trades before it's placed. Nothing is made, no decisions are made on the fly. There's no discretionary component to this. So a lot of traders, if they wanted to trade this stock to the short side, they'd probably short it here, you know, cut it again, and they would have several paper cuts on the way up. But I found that for our style of trading, that just creates more FOMO, more emotional trading decisions. You know, it makes your broker rich with commissions and slippage and all of these things, especially if you want to scale your strategy. You can't just enter and exit as quickly as you can with 100 shares, right? Imagine if you're trading this with 10,000 shares, 20,000 shares, the slippage will really add up. So that's where having a high win probability strategy can save you money. Whereas if you're trading a small account, you won't consider it that, you know, as beneficial. So this is the reason that I post these charts, just to bring awareness. You know I understand I get heat for these charts, which is fine. I mean, I accept all criticism. I am 100% transparent with my strategy, and I challenge anybody to look at my databases, look at my strategies, and say that this trade was bad.
On this trade, can I just ask, were you watching it, or did you just literally enter, set stop, go to the gym or whatever? Whatever you're there.
That's a good question, Sam. So I'm actually a strong believer in the set and forget method. I feel as though manipulators and algos, they prey on our emotions because they know that we're sitting there watching the trade every step of the way. You know, we're watching every tick. So when something happens that we don't like, there's a chance that we might get emotional and do something irrational, right? If you're not even watching the trade, you just set your stop loss, which was predetermined, then none of the manipulation, none of the algos, none of this stuff can affect you. You're completely immune to manipulation. And that's the edge that we hold with our wide stop strategy. Anything can occur in between our entry and our stop, and we're not even affected by it. So sometimes I do just take a break, I'll walk away, and other times I'll just watch, and it doesn't affect me because I've reached such a level of conviction and maturity in my trading where none of this stuff impacts me. I know that my probabilities will come through over time. I'm not going to overreact to a certain trade going against me. Now, let's say this stock did keep ripping and we stopped out for, whatever my stop loss on the trade, probably 30 to 40%. That's fine. I would stop out, no problem. I wouldn't get back in. I wouldn't revenge trade it unless it triggered a valid signal later on in the day. I think a lot of traders, when they get in a trade and they stop out, they'll continue to fight the stock. And this is the biggest mistake that rookie traders make, especially with my strategies. They'll keep fighting it. And on those rare those blue swan situations where it just keeps ripping, that's when they blow up their account. So you really have to, just get out, respect your stops, and leave it.
Mm-hmm. So you've essentially built into your system the potential for a large loss like that. And if it were to actually hit that, and you would accept that, knowing then that over time, your system's still going to work.
Right, exactly. So every potential possibility, say a max loss or a sub-max loss or a small win or a big win, each of those outcomes has a probability assigned to it that we determine from the historical data, what has happened in the past. So we look at this exact scenario and say, okay, over the last 500 times this exact setup presented, what happened, what occurred? And when we're able to quantify each individual segment, then we can run simulations based off of that. And we say, all right, if we take a max loss, say 10% of the time, can we still make money with this trade? And the answer was yes, obviously. So I took the trade and I accepted any outcome that resulted. See, we don't really predict what's going to happen. We don't care what's going to happen because we know that it's going to fall into those predetermined probability ranges. And it's all, based in our simulations, and everything is quantified objectively. There's no discretion. There's no subjectivity to this. So that's why I say one entry, one exit, 100% execution. I executed this plan perfectly. It doesn't matter what happened in between. People will always look at the negatives and magnify those. But if I showed a chart where this, dumped right here and faded all day, then there'd be no comments.
Right.
So that's the focus of most traders.
Go ahead.
No,
No, I was going to say, it just reminds me a little bit of, I used to play quite a lot of poker, and like, even if you've got the best, obviously, as if you've got pocket aces, you could be up against any two cards and you can still lose. Right. And ultimately it's the same in terms of, you can have the best setup, everything can be in your favor, but sometimes it's not going to work out.
I'm curious here, if you don't mind, Kris, without giving away too many of your top secrets, just, most people talk about the exits on this trade. What I'm curious about is kind of like your entry signal. So you've got one entry, one exit, 100% execution. Like, what triggered this for you at that moment in order for you to have that confidence? If you can think that far back.
Yeah, I don't remember the exact entry signal on this setup, but excuse me. Every single setup that we have has a entry signal, and that's based on what we've back tested. So the majority of our setups are gappers. So we would take the entry right at the open. And I know a lot of people, they want to wait for a push or some sort of extension on the open. And I've shown several times through my webinars why that's actually worse. And the reason being is the most trappy and manipulated stocks will have some sort of push or spike at the open. Like if we look at a chart today, it was an INDO. It triggered a valid day 2 setup for us. And as you guys can see, if you look at the chart, it was very trappy and manipulated out of the gates. And if you were waiting for a spike or a push out of the entry, you would have gotten a better entry price for sure. But when we look at specific stocks that do spike, the returns overall are actually worse because you're capturing only the ones that will result in losses. And you're missing all of those trades that are just all day fades with no push, unless you're willing to chase it. So that's why we take an entry at the open, because the chance of a complexion change from pre-market to open is very high. The price action can change significantly from that opening bell moment. But if you're in a stock that's already showing trappiness, it's showing manipulation, then the probability of a complexion change is less. That's what we found through our databases. That's why when we take entries, it's right at the open. And a lot of people disagree with this. They say that our entries are poor. They're not, they're not good entries because you're not waiting for extension. But we just let the data guide our decisions. If waiting for an offset was better, then we would do that. But we found that by taking entries at the open, you can capture all of those stocks that are incredibly weak right out of the gates. And, you would miss those otherwise. So that's why we take entries, right where our trigger points are.
But with this trade here, you've taken it, looks like around lunchtime.
Yeah, I actually don't remember the trigger criteria for this trade, guys. It may have been a parabolic setup. We've got like 6 or 7 setups that we trade. So this one I don't recall. It was September, quite a long time ago.
So each of your setup then, does it also have a different time sensitivity as well?
Yes, there are time restrictions. Like we have windows where we'll take the trade, or if it's too early, too late, we don't trade pre-market. We usually don't trade past like 1 p.m. Eastern. or at least take entries past that time, because we want to allow the trade to work, right? We want to have at least a few hours for the pattern to play out. And we found that patterns after 1 p.m. Eastern usually don't work well to the short side.
Mhm.
Fair enough. And do you actually implement some sort of volume and price analysis into your strategies? And is that, if you do, does that insert any kind of discretion in there?
Yes, we do have volume filters and criterias. Usually the lower the volume, the better for us, right? The lower means there's less attention on the stock. There's less likely to be algo manipulation. Like, let's say a stock is trading under 1 million volume. It's unlikely to be manipulated or crowded at that time. But if it's already trading 20 million volume pre-market, then we know all eyes are on it. It's probably going to be trappy. It's going to be difficult. So we prefer targeting lower volume stocks for sure.
Fair enough. Fair enough. So it's kind of, it fits maybe into some broader criteria than like with your volume, or perhaps even like float rotation or something like that, I would assume.
Right. Yeah, we are actually getting into more, we're trying to code our own volume forecasting right now, actually. So we're looking at all possibilities. A lot of the projects that we've been working on during this downtime, we get so much free time right now. So we're kind of trying to stay busy and working on projects. The CRR, the chart resistance rating, that's a project that we've just completed, and we're fine tuning that as well. I can show you guys a few examples if you like.
Yeah, let's do it, man.
Let me blow this up a little bit. So I put together a few slides for you guys, just a nice little bonus for your viewers.
Awesome, man. Thanks.
So this is a tweet that I posted on my Twitter a couple of years ago. You guys can see the date, 2019. So this tweet, I think, single-handedly turned my career around. This is around the time where I became profitable. And I can still distinctly remember the time that I tweeted this. I had just recently blown up an account. It was during a reflection phase of what had happened, not again. This is happening for the 10th time or whatever. And I fully came to the conclusion that I have to detach from the money. I have to be more focused on executing my strategy and my plan than actually making money. Because the only way to make that money is through sound process. Whereas we as traders, we go into the trading day with the wrong mentality. I think a lot of guys think, I need to make $500 today. I need to make $1,000 today. I need to do something today. But what you need to do is be patient and follow your plan. And if there's no trades to be made, then so be it. I think a lot of traders have the issue of going a day without a trade because they feel as if they didn't do their job. Right? We're here as traders. This is our job. And if you sit on your hands all day without doing anything, then you feel some kind of, like you should have done something. I think that's a mentality a lot of guys have. But you realize that over time, you make more money by doing nothing. So this is something that you'll appreciate, as you grow as a trader. And I fully embraced that mentality going into 2022. It was one of my trader resolutions that I want to just execute perfectly. I noticed that once I crossed the $1 million mark in my equity curve, that my execution was dropping. Maybe that had to do with a large profit cushion, maybe a bit of overconfidence, but I felt like I wasn't executing as well as I had when I was in this, learning phase back in 2019. So this year, my goal is basically to get back to the basics, to start executing better. And, if that means not trading for an entire week, then so be it. I'm okay with that.
That's awesome. Yeah, I mean, you have been. I've noticed your Twitter here lately. How many days have you gone without a trade?
It's been pretty brutal this month, guys. I think 13 days of this month I've not placed any trades.
Wow, that's awesome.
Definitely a career record. But the thing that has surprised me the most is that despite that, I'm still having a very strong month. I'm up around 60,000 and some of the best efficiency metrics I've had in my entire career. And one thing I will say that is a bit underrated, my blood pressure has been the lowest in years, guys.
I bet.
That's awesome.
That's a plus, saving some years off the end of my life here.
No doubt.
Anyways, so this is one of my A+ setups I just wanted to share with your viewers. So this is what I call a post-pump setup. So this was GNE, I think summer of 2020. It had this massive run from like $2 all the way up to 10 on massive volume. right? So day one, these things are incredibly dangerous once they start ripping and showing that it's like a black swan. But the best setup is waiting a few days later, and then it starts spiking up to a prior consolidation resistance area on lower relative volume. So this results in like a trifecta of confluence factors. You have other bag holders who are looking to sell. You have other short sellers who are seeing this as an A+ opportunity. And then you have long traders who are not eager to buy this. Like if you're a long trader, there's no way that you're going to look at this and say, yeah, I would love to buy with massive resistance overhead, tons of people probably going to be selling into this. I'm not going to touch this. So you basically have all selling and no buying. And that's why this faded on almost no volume. So these are some of the A+ setups that we look for. And the beauty of the COVID madness market is that we have endless amounts of these setups. Just in a few days, we've seen these setups pay out and they've just been dumping all day long. PFIN was an example today that we missed. I've seen a lot of pumps lately go red on the day because there's just so many bag holders looking to get out. And there's no buying volume. Like people are in a state of fear right now with the market crashing. They're not really willing to buy the dip anymore. Now it's sell the pop. So these are the setups that we look for.
Yeah. Would you mind if I ask you about it?
Yeah, go ahead.
Yeah, I mean it looks like a pretty straightforward setup. You've got your like you were saying, your prior supply area there with a nice little rectangle, and it kind of like a point of control line maybe you've drawn there. What I'm curious about is, you place your trade right at the open there. It hits your your entry criteria. What signals to you to take profits? Right where you did, I suppose, versus somewhere else. I don't know.
Right. So everything that we do, like I said, is predetermined based on the historical data. So if we look at this exact pattern over the last 1,000 times it occurred, we can know the probability of a 15% gain or a 20% gain. And then we can base our profit targets off of those levels. But the reason I probably took profits here is because the volume really dried up. And I don't like to trap myself in low liquidity situations, especially as you size up as a trader. You don't want to be holding full size when the volume dries up, because what happens if this starts skipping up on you on no volume? You can get squeezed out in some ugly situations. But all of our profit targets are probability based.
Got you. Is it more of like do you ever take like an RR type of play where it's like, okay, I've risked one unit and I've reached 3, so I'm going to now take my profits regardless of what happens after this?
If it reaches a certain profit target, then we will take everything off, usually around 30%. But basically everything that I look at is based on the expected growth. I don't use risk ratios or R multiples like a lot of other traders. I use expected growth, which is a mathematical formula based on the Kelly Criterion. So it basically looks at, if we take a certain action, what is the expected growth potential when we compound our account? And that's the most important thing as a trader. I think, when we come into trading with a small account, we're all trying to grow exponentially, right? We're all trying to take like a $10,000 account and make $500,000 with it. And the fastest, most efficient way of doing that is with compounding using the Kelly Criterion. So that's why I'm trying to bring more awareness to Kelly and expected growth and all of these mathematical formulas that we use.
Awesome, man. Yeah, great trade.
So that was a Gene trade. A few other trades that we had. This is a sample P&L from the COVID madness when things were a little busier. I kind of miss these days, but
I bet you'd love to see 10 tickers on your end of day.
Yeah, I wouldn't even believe it right now if I had 10 trades in a day. I'm happy with 1 right now. But this was I think this was in late 2020. Just an example of the parabolic setups that we like. We short extension in a short period of time. And this was just a recycling technique that we use, cover into a heavy wash, reshort at resistance, typical stuff. Here's another one, ears, short a parabolic, cover into a wash. And then once a certain range is set, we use things like tape reading, level 2 analysis to determine where a stock is going to top out, where it's going to bounce, where it's going to reject. And once the levels are kind of set, then we can replay those levels with smaller size and just add on. So some fairly nice P&Ls from those days. just want to go over a few psychology components that we talk about, like habits of winning traders. They always take A+ setups. They don't hesitate. They accept losses as part of trading. They don't dwell on them. So if I have to take a max loss on a trade, I don't care because I know it's factored into the probabilities, right? So every outcome that occurs, we don't attach any emotion to it. Even if it's a big win, we try not to get too high on ourselves, right? Just stay even keeled. Good traders, they focus on executing properly, not the P&L. So like I tweeted today, I'm not willing to sacrifice my execution just for short-term profits, right? Because if you're doing the wrong thing to make that money, eventually you're going to get punished by the market. So doing the right thing, regardless of P&L, is what you want to focus on. So they have a statistical, data-driven approach, keep a long-term approach. Like, don't have tunnel vision, basically. If we take a couple of losses, I think guys lose faith, they lose conviction. It's so easy to focus on the immediate P&L because we have to live through it day by day, right? We sleep with it on our minds, and it's hard to let go of that and not allow it to impact our trading the following day. But a tactic that I use is I just kind of reset my mind every morning when I go into the trading day. It doesn't matter what happened the night before or the week before. Every day is its own like entity. And that's why I try to keep things independent from the prior day or the following day.
Nice.
So predetermined position sizing, right? We know exactly how much we're going to put on the trade before it even happens. We have cheat sheets that I'm going to show you guys where it shows everything, like everything is laid out. We don't take any chances. We don't make any guesses. There's no discretion to any of the decisions that we make. And
So
that's what,
if you see something that's like A+++++, you don't go a little bit extra on the size, or it's all just like cut and dry.
no, we actually do have strength specific sizing. So we know how much to put on a B setup. We know how much to put on an A setup. We specify our strengths of strategies.
That's cool.
Because
so you've actually got that baked in. Like when you want to go heavy, you actually have criteria for going when to go heavy.
Right, exactly. And that's actually what I've been focusing on myself. I'm just trying to take the A+ trades. And I think a good way of improving your edge is to know when to size up and when to size down. I think a lot of traders, they just see all setups the same, but when we quantify things, we're able to determine, okay, this is an A+ setup. The math is dictating that we go heavier. Or this is like a B- setup. The math is dictating that we go smaller. And this way we can skew the metrics and improve our edge.
To that point, Kris, if I may, is there any truth in the saying of base hits? Base hits add up, or in kind of like your statistics, what would you say? Home runs are better, or base hits? Because you hear these days, like baseball outfits they want the home run hitters, or versus.
Yeah, that's true. I mean, my personal philosophy of trading is just focusing on the best of the best, right? It's like the 80-20 rule. 80% of your profits are going to come from 20% of your trades. So you might as well focus on those A+ trades for a few reasons. Mostly because most guys have a small account. If they're under PDT, then why not just focus on the best trades where you can make the same amount of money and you're not handicapped by those 3 trades per week. Secondly is let's say you do have a large account, you can take multiple trades. There's a lot of mental capital burn when you're taking weaker setups, a lot of buying power tied up, and a lot of opportunity costs. What happens if you're focused on a subpar setup and an A+ setup just flies by and you miss it because you're drained mentally or you're not focused properly, right? So the opportunity cost is something that you have to consider. A lot of guys don't take that into account. But I just think focusing on A+ setups will do you more good than harm over the long term.
Got it.
And Kris, just on, you said the math dictates the size you take, whether it's B or an A. I'm just interested, is the difference between an A and a B a higher win rate or a higher expected, like dollar, is it profit amount is what I'm trying to just determine between the two?
Well, the determination comes from the Kelly Criterion formula of expected growth. And generally speaking, win percentage or win rate will increase the strength of a setup more than anything else. And this is why we use wide stops, because the wider the stop, generally the higher the win probability. And the higher the win probability, the stronger the compounding strength and the higher the expected growth. So that's why we're willing to use massive wide stops that people think we're lunatics or, gunslingers for using. The reason being is because we can increase our compounding strength with a high win percentage. Everything is mathematics based, guys. We don't make any discretionary decisions. And a lot of the decisions that we do make go against common trading wisdom, but that's why, we're contrarians by nature, we're outliers.
Oh.
So next slide, habits of losing traders. So this is a lot of things that we fall victim to, I think, myself included: revenge trading, bag holding, having short-term focus, tunnel vision, focusing on the money instead of the process or the execution, changing strategies or systems after drawdowns. A lot of people are, victimized by this. They have a few losses and they jump to another approach, or they change chat rooms, or they, tweak their settings after a few losses. But you have to understand that losses are a part of it. It's going to happen.
Right.
And another thing that I think a lot of guys are affected by is Twitter or social media. We see traders on Twitter making big money, doing this, doing that, and it impacts us in some way, right? It forces us to trade more size or trade outside our comfort zone because we feel like we have to match that. It's just a subconscious thing. So I try to, detach from Twitter or social media when I'm trading. I don't allow that to impact me. If other guys are making a lot of trades and making a lot of money, I try not to get any FOMO from that. And then the biggest thing is blaming external sources, right? If you're in a chat room and you lose money, it's human nature to blame the guru, right? Guru lost me this money, it's their fault, I'm going to leave or go to some other place. But successful traders will always take, the onus on themselves. They'll take responsibility for their trades.
100%.
So this is actually a project that we've been working on. It's the KVS Infobot. So we've been working on chart resistance ratings to improve our setups. And this is largely how we're determining what an A+ setup is versus just a B setup. And it comes from the resistance on the chart. So in the Discord, what we can do is we can query the bot by just typing in the ticker symbol AMC, and then it will bring up the highest resistance on the chart, the most recent resistance with all the metrics, and then the highest volume day resistance metrics. So when we look at all three of these, we can calculate and determine like the total resistance block, which is basically the amount of shares multiplied by, say, the VWAP, which gives us a dollar amount. So this is 53,000 million. So I guess that's $53 billion traded on AMC for the amount of resistance that we're looking at. It has 40 resistance layers during the last year. And then here's all of our setups that where the bot tells us if it's valid for an A+ setup or not. So when we look at this and it's beating one of our entry criteria, we'll quickly look it up in the channel and, all right, it says valid. So that means it's an A+ setup. So then we have sizing parameters for that A+ setup and we go in like twice as heavy. And here's a few ratios that I look at. The biggest thing that I look for is the resistance volume versus the relative trading volume. So let's say the resistance layer is 53 billion and the stock is only trading 100 million. So that ratio is very high in our favor. There's a lot of resistance relative to the current trading price.
So on just imagining this on a chart, you're thinking like, this high volume resistance level, maybe similar to a point of control or something like that. Yeah. But you're waiting for the stock to actually come within a certain area of that on a certain day's volume as a ratio of that prior day to kind of give you the I guess the confidence or the criteria for like, is it an A+, that sort of thing.
Right, exactly. So what we've been able to do is quantify resistance in a completely objective manner, right? So a lot of times when people look at a chart, they say, this has good resistance or this has weak resistance. But what does that actually mean, right? It's just an opinion. If we look at a chart, 10 people may say this is a 5 out of 10 or a 6 out of 10 or 7 out of 10. So by being able to quantify things, we can look at the ratios, the metrics, the percentages, and determine from that what quantifies or what constitutes an A+ setup versus an A- setup. So one thing that we look for example, is the position of the highest resistance high of day. So right here for AMC, the highest resistance high would be $72, right? So we want this to be a certain percentage away from the current trading price, such that we know that there's nearby overhead resistance, right? So that's one of the criteria that we look for. Or another criteria is we say, all right, we want at least 5 resistance layers. So we know that the stock has had multiple volume days, it's been in play several times. So there's like multiple layers of bag holders who are willing to sell into the spike. And we just look at like, there's about 10 different ratios and volume metrics that we look at in the CRR formula. And it's still in the works. You know, we've just developed this, but it's really exciting technology that we're looking to advance and grow upon.
It's really cool, man. I'm kind of curious, like what would put then AMC on your radar then and have you type in that bot just to pull this information?
Right. So AMC is actually just an example. There's not many setups that we trade that would include AMC because it doesn't gap much. It's not that volatile, right? Nowadays, it's just kind of bleeding out. But let's say tomorrow, somehow by some miracle, it's gapping up 50%, right?
The apes win for a day.
Exactly. The apes would be, you know, very happy. They're going to claim it's going to 1,000 or something, right? But obviously we would have the opposite approach. We would be looking to short it. And we would say, okay, let's look at our CRR criteria. Is there nearby resistance? Is the volume outweighing the current trading volume? Is there enough of a resistance block? And all of that is automatically calculated in the bot. Because if we had to calculate this by hand on the fly, it would be very difficult and time consuming. So by being able to code this into the bot using Python, it just saves us a lot of time and just streamlines our entire approach.
So then basically, you know, hypothetically speaking, then if AMC were on like your gappers list, so your universe of stocks is really just looking for those volume gappers, and then maybe like narrowing them down using this tool to find the best opportunities.
Right, exactly. So our baseline criteria is that we need a stock gapping at least 25%. And then we have on top of that additional criteria that would filter the stock and, you know, categorize it into strength categories like B or A or A+. So if AMC was gapping up 50% tomorrow, then it likely would meet our criteria for sure.
Cool. That's awesome.
So here's another slide that I put together for you guys. And this is just kind of displays the importance of position sizing. So if you guys are not familiar with the Kelly Criterion, it's basically a percentage of your account that you should put on the trade that optimizes bankroll growth when compounding. So 1.0 or 100% of that number is the full Kelly stake and results in the highest return. So the blue line represents the return and the red line represents the volatility. So as our Kelly stake increases, we notice that our volatility increases exponentially, right? And our return also decreases after the 1 times 100% Kelly stake. So this is the ultimate tragedy that I think most traders fall into, is that they're always oversizing. They're always trading larger amounts based on their account size, and that's hurting them because they're ultimately losing money. So that's why I always recommend to, you know, new members in the room to trade with less size. Size and less because you can still retain very good returns with less volatility. I always say to my students, imagine this red line being your blood pressure.
Yeah.
Right? As you're sizing up, your blood pressure is also going up. So you want to keep that as low as possible with, you know, reduced size.
And to that point though, is that the volatility of your account? That's not the volatility of the stock, correct?
Correct. Yes. This would be the volatility of your equity, of your bankroll. So
Okay.
this is good and bad. So like we mentioned before, those students who came in initially and had success with high Kelly stakes, if they had joined during a winning streak, they would be, you know, euphoric because they were, you know, tripling, quadrupling their account in a short time frame. But as soon as things turn around and it reverts to the mean, then they're losing quite a bit, and their, you know, their confidence is hurting as well. So it's always better to size in less, because this graph basically represents the fact that you can have the strongest edge in the world, but if you oversize relative to that edge, your return is almost negated. So that's why position sizing is almost as important as the edge itself. So
What's interesting about this then to me is that, most people kind of judge their size sometimes based on the volatility of the price action. But this
Okay.
is more, based on just the statistical edge, and it doesn't really matter what the volatility of the price action is. Am I right?
Well, we do take into account the volatility, the expected volatility of the setup. So
Okay.
if we're trading, let's say a 300% gapper, then we know statistically the range will be wider. We know that the spike will be higher and the max gain will be higher just because there's more range to be had with the stock. And the mathematics will determine that we'll likely have to size in less to account for that volatility. Whereas if we're trading a 20 or 30% gapper, then we know the range, the expected range is less. So then we would be sizing in accordingly, likely heavier.
Cool.
So Chris, what would you say to someone who was a constant, my risk is 0.5% in my account or 1% in my account? What would you say to them to convert them over to this way, to the Kelly Criterion?
Okay. Yeah, I think that's like commonly accepted trading wisdom. You should risk like 1 or 2% of your account at most. And what I would say is that really only applies if you're trading like a $5 million account, right? Most guys, let's say you're a typical trader, you're new to the markets, you're coming in with, let's say, $10,000. If you lose that entire amount, it's not the end of the world. You can probably make it back with a side job or some sort of outside income. It's not going to crush you financially. So why not risk more of it and be aggressive with it and try to go exponential? Because I'm not sure if you guys knew my story. When I turned my trading around, I turned like a 3K account into 7 figures. And that only occurred by being very aggressive. I was risking 1 or 2%, then I would have had a fraction of those returns. So what we do is we actually give simulators to our members, and they can enter in the percentage that they want to risk per trade. And it will show you, the equity trajectory and the drawdowns, the max gain potential, and you can determine for yourself what you're comfortable with. So if 1% is suitable for your risk tolerance, that's fine. But I would always recommend being, more aggressive and just doing what's most optimal, what the numbers dictate.
That's awesome.
This is where this graph comes into play. It just kind of shows you the potential, but not over risking your Kelly stake and then essentially just reducing your return and having unnecessary volatility.
So you want to kind of be in that sweet spot there, I would assume, from like 0.5 to 1.
Right. So 0.5 is actually the Kelly stake that I recommend because it cuts our volatility in half, right? So our volatility on a 0.5 is right here versus at 1 is right here. So it's half as much. Whereas our return is 75% of optimal, right? So you're skewing the metrics in your favor. And then we also have to consider the execution aspect. You have to consider how hard or easy it will be to execute a strategy when the volatility is this high, right? If you're risking a high amount with high volatility, most people will not stick to the plan, right? They're not going to be able to take a max loss, or they're going to take profits early because they're going to be nervous of losing the money. So it's easier to execute when you have less money on the trade.
Got it.
That's something that we don't really consider as traders. We're always looking for home runs, right? We're always looking to make it big on one trade. But when we think back, like how often has that ever happened? Whenever I'm in heavy size on a trade, I'm either taking a loss or I'm piking out for small profits. I've never really been able to extract it.
Chris, do you think it would be worthwhile to show viewers how to calculate that Kelly criteria?
Yeah, we can definitely take a look at that. Like I mentioned before, we're going to give a sample tracking template to the viewers as a nice little bonus here, and I'll show you guys how it works and how it calculates everything. So all you really have to do is just paste in the raw values, and all the metrics are calculated for you. So this is a table that I just want to touch on before we move into that. So this is like a cheat sheet, we call it in the room. We have this for every setup. So SOPA was a day 2, A+ day 2 setup a couple of weeks ago. So we just type in the price that we're looking to enter, usually at the open. And then all of our targets and our stop probabilities are given. They're calculated automatically, and it's all based on the historical data. So it shows like all of the profit targets. And if we were to take, full profits at a 5% gain, it would be a full cover right here. And this would show that we're actually losing money per trade if we were to cover everything at 5%, because we're undercapitalizing on the setup. And right here is the sim EG, the simulated expected growth. So when we run a 30,000 trade simulation, we can calculate the average expected growth per trade with each outcome. So if we cover, say, 15% of the position fully at that point, we're going to have 2.4% per trade. But if we waited for 30% gains, we can extract 9%. So when we have the data in front of us like this, it helps prevent us pike out from the trade, and it helps prevent us from stopping out too soon. Because if you guys will notice, the wider the stop that we use, the higher the simulated expected growth, right? If you use a 10% stop, your expected growth is 3% with a 5% average return per trade. The win rate is 48%, and we should risk 95% of our account. We should place 95% of our account position dollar value using a half Kelly stake. And the returns are still good, but we can triple that by just using a 30% stop. And if you told this to most traders, they would, they would reject that idea initially. I think they wouldn't accept it because, they've been told their entire career that tighter stops are better. But as we can see, with a 30% stop, there's a 16% probability of being stopped out. The halfway probability is basically a conditional probability. So if we're down 15% on the trade, we now have a 44% chance of stopping out. And this is derived from historical data that we're going to show you in the templates. So we're going to average 12% gain per trade. The simulated expected growth is 9%. The win rate is 78%. And we should place 87% of our account on the trade. So going back to that chart that you showed me before, John, about the wide stop mentality, this is where that conviction comes from, right? We don't make any decisions, based on discretion or what we think is correct. We just let the numbers tell us what is correct.
So
right?
when you're taking that ride on VCNX, you're thinking this chart right here that, hey, I'm fine. I'm doing all right.
Exactly, because I was following the plan that we placed before we went into the trade. So as long as we're executing our plan perfectly, then the outcome doesn't matter, right? If you can become outcome independent, then you're one step ahead of the game, right? We're not attached to the money or the outcome. We're attached to executing our plan that we predetermined before the trade. And that's what I try to stress in the room all the time. But it's so difficult because, we're constantly looking at our P&Ls, and, money is a very emotional thing. It's very difficult to detach your emotions from the money, especially when you're in a losing trade. But it's also difficult to detach when you're in a winning trade. Because let's say, we're in a winning trade, we're up 10%. The temptation to take profits is very high, right? But I'll quickly just look at my chart and say, all right, if I take profits at 10%, I'm sacrificing a lot of expected growth. Whereas if I hold for 20%, I'm maximizing my growth potential. And this is the reason that I include these halfway probabilities to help prevent piking out.
Yeah.
What it means on the profit side is, let's say we're up 10% on the trade, right? Most traders would probably take a partial there. They'll take some profits, reduce their risk, reduce their stress. That's human nature. But I'll look at my table and say, all right, a 20% gain. Once we're halfway there, so up 10%, there's an 81% chance that we'll reach 20%. So there's an 80% chance I'm going to double my return on this trade. So why should I cover now?
And Kris, just on, obviously this is a SOPA example. How much does it differ by ticker? Because I'm just looking at, for example, 30% stop with this one is the sweet spot. You seem to have mentioned 20 and 30%. I think you mentioned them a couple of times whilst we've been chatting. So is that typically always the sweet spot in terms of a stop?
It depends on the exact setup. So we have different stops based on the setup. But without giving away too much, I will say that 30% is my go-to stop percentage.
Sure. Nice.
Right. So why don't we actually look at the template Let me pull that up here for you guys. So this here is the KVS database that we give to all members. Right here is the data tracking log. So this is a sample template that we can use to calculate all of our metrics and our formulas. So this area right here, we just paste in our raw fundamental data. So you can get this from any source. Polygon is something that we use. We're teaching how to use Python scripting and coding to get the formulas, but we also have it coded into the KVS infobot where it will provide end of day data. So you don't even have to track this yourself. You just copy and paste it straight in. And right here is our formula section. So we'll calculate the gain percentage from the open to the close, the spike percentage, the max gain percentage. And then if we apply a stop percentage, like 30% stop, what's the adjusted gain? So right here would be minus 30% because we'd stop out. But if we had no stop, it'd be minus 8%, right? And then here we have a fee deduction. We deduct like 1.75% to account for fees, slippage, locates, things like that.
Now, is that data based upon an individual stock's history or like an aggregate of stocks kind of in that bucket of volume, float, that sort of thing?
It really depends on what you want to track, John. So right here is basically end of day data for certain gappers of the day. So let's say 30% gappers. So let's say we want to track 30% gappers. We accumulate a database of 1,000 tickers, and then we want to see, okay, how can we extract an edge from this data? And it's through these formulas and templates that we're able to do that. I'm going to show you guys right here. So this gray area is the filter range. So this is the magic of this spreadsheet. So what we can do is, let's say outstanding shares. We want to look at all stocks that have outstanding shares of between 0 and 5 million. So we'll just put it to 5 and 20. So a 1 will show if the value is between this range. So we can look back here and see, okay, the float here is 8 million. So it's showing a 1, right?
Mm-hmm.
But these two, it doesn't show because the float's only 2 million. So it doesn't show up in this filter criteria. So if we go through our entire list of all the fundamental criteria that we look at, we can filter specific ranges. And at the end of the list, it will say all criteria met. So it will only show a 1 if every single criteria is valid. And when we're able to do that, we can look at a specific sample of data, and then all of it is reflected here. It will show the gain per trade. So the perfect gain, I like to call it, because everything was met, so it's considered perfect. So these 4 trades met all the criteria, right? So it's a perfect trade. And we have 3 winners, 1 loss, resulting in a 75% win rate. The profit ratio is 2.8 because the average win, 21% divided by 7% average loss is 2.8. And then the edge right here. So this is a mathematical calculation of edge. It's how we quantify what edge really means. And if we look at the formula, it's 1 plus the profit ratio multiplied by the win percentage, then minus 1. So that puts edge in a percent formula. So it's 190% edge, which is obviously, very high, somewhat unrealistic because we only have a 4 trade sample. But this is how we determine, if we look at this subset and say, okay, we do have an edge here. We have our expected growth of 69%. And then we have our simulated expected growth because this tracking template is actually logged and tagged to a simulator, which uses all the metrics. I'm going to show you guys how this works quickly. Actually, why don't we look at the cover targets that we can get to the simulation. So right here, it's going to show the spike percentage, the max gain for those perfect criteria only, right? 4 trades, and it's showing all the metrics. So we can look at, is the spike percentage more than the max gain? Is the cover efficiency over 90%? So these are the metrics that I look at to make sure that a strategy is really strong and really tangible. And then over here, it gets a little confusing, but this is how I calculate my conditional probabilities and my cover targets. So let's say we want to cover 50% of the position up, 25%. So we'll show our new updated gain per trade, right? 14% was here, and it's 11.9% here if we cover half of 25%. So we're actually sacrificing some returns.
Yeah.
And that's generally what happens when we take partial covers. So usually the best metrics are found when you hold a full position till end of day. So taking partials generally sacrifices your returns, but this way we can see how much we're actually losing. Right, so we have a 25% probability of reaching this cover target because one trade out of the 4 met that target. And then we have conditional targets here. So we can say once we're up 10%, what's the probability of reaching our full cover target? And it's 50-50.
Okay.
So these will make more sense when we have a larger database, but all of the explanations are down here so you guys can, kind of play with this at your own time and figure it out.
Yeah, that's awesome, man. And you're going to provide that as just like a template, or?
Yeah, exactly. So we'll just give this to the viewers as a nice little bonus, for tuning in here, and they can play around with it.
We'll throw those in the YouTube comments down below.
Yeah. If they have any questions, they can DM me about it. I love talking data, guys. So
that's awesome, man.
This is something I can talk about for hours, as you can tell. So this region here is our stop loss area. So we do the same thing with the cover targets. If we want to do a stop right here, let's say we do a 50% stop, and all of our metrics change. It tells us the probability of reaching. Obviously, none did. Let's set it to 10% so we can get a better example here. So we get a 25% chance of stopping out. And then if we are reaching the stop level, if we're down 5%, what's the conditional probability? So escape is like 75% chance of not stopping out, 25% of reaching it. These numbers are a bit skewed because the sample is small, but it makes more sense when you have a large database.
Yeah.
And this pink area here is our simulator. So it basically separates all of the outcomes into probability ranges. So either max loss, sub-max loss, small loss, and then all the win ranges. So here's the count of all of those occurrences and then the probabilities. So if we look at our tracking simulator, it's copied into it right here in this table. And then it basically uses a random number generator and then uses that and simulates 1,000 trades. And as we can see, this would be the growth trajectory if we were to trade that sample.
Yeah.
So all the averages are based on the historical data, historical returns, and this is how we calculate our true expected growth or our simulated expected growth. So everything is quantified, it's systematic, it's math-based, and this is where we derive our confidence from, guys.
Now, are you mostly outcome testing, or are you also populating with back-tested data and mixing both of those? Does it matter?
Well, the general idea comes from back testing, right? We want to see, does this idea produce returns over time? And then we forward test it by tracking the data on a daily basis and make sure that those numbers are retained, right? We want to make sure that the strength of a setup is retained in all market conditions. And that's what determines, the validity of a setup for us.
Got it. Wow, that's a lot of data.
Yeah.
Yeah, I can see why you would, you would have confidence in the strategy over time, because it's, you, like you're saying, if you have that position go against you, being able to trust your data, it's just super important, right? I mean, I guess it lends that extra, that confidence to your psychology and your mindset when you're in the trade.
Right, 100%. The amount of confidence and conviction that we get from these databases and templates and simulators is everything, really. If I didn't have this stuff, I wouldn't have the conviction to trade, and I wouldn't have the confidence to keep going during drawdowns.
Right.
And I think that's the most important thing. When we're in a drawdown, it's so easy to lose confidence, guys. I mean, it happens to me, personally. If I'm in a drawdown, I lose faith in the setup, I lose faith in myself. It's just human nature, I think, to some degree. And the only thing that grounds me and restores my confidence is when I come back to my databases and I come back to my spreadsheets, and that convinces me that things will turn around.
At the end of the day, you've got to have that discipline, like you were saying, that you lacked from the early years, but that you've been showing this past month, that even when your setups are not there, you've got to wait for something that fits the criteria in this spreadsheet, basically.
Exactly. Because what I've found, John, is that if I take a discretionary trade, instantly I'm lacking the same amount of conviction that I would have otherwise. right?
Yeah.
I'm not able to hold full size. I'm not able to extract the profits. So my execution is already going to be bad. So I know I'm not going to be able to, take advantage of this trade. So what's the point? I'd rather just wait for something I have full confidence and conviction in so I can execute it properly.
That's awesome. Yeah, thanks for sharing that, Kris.
Yeah, no worries.
Chris, you mentioned that you've largely focused on small caps. Have you looked at larger caps, or is that in the pipeline, or do you just think there may not be as much of an edge there versus small caps?
That's a good question, especially during this slow period. We have been venturing out looking for other opportunities, even crypto. But I've not been able to find the same level of expected growth or edge percentage with these setups, and especially in large caps. I just don't think it exists to the same degree because the markets are slightly more efficient. There's more, high-end competition. So I don't think you'll be able to extract money from those, securities as easily as small caps. So I'm fine, just waiting for things to heat up. I know things will eventually. So when they do, we'll bank. We don't need to, deviate or venture out of our comfort zone. But if those edges did exist, I probably would trade them. They're just not as profitable or lucrative as small caps.
Yeah, have you ever looked at the long side?
Man, I tell you, when I'm getting squeezed out on some of these plays paying like 30, 40 cents a borrow, I think about it for sure.
Yeah, what I was thinking about, like that A plus setup you showed. I don't know if it was SOPA or whatever it was, but yeah, no, it was Gene, I think, GENE. So the Gene, the GENE ticker, you got that big run, and this is something that I've written about for Tradingsim, and it's actually something I'm a bit more long biased, and not necessarily biased, but I just prefer to trade that side. It's been kind of slim here lately, but you see sometimes in this market where you get that big run and you get the pullback, and then you get that test, like you shorted that third day on that retest of supply. But it seems like nowadays we're starting to get these liquidity traps where they just kind of, they test those supply levels, test them, and then as they continue to test them, it's almost like the shorts that were piled in on that day, they're just, they're in hot water, and you end up getting a nice little multi-day breakout.
Right.
Maybe like SBEV recently or something like that. I don't know. Do you ever get stuck in those, or is it just you hit your stop? And
yeah, I mean, I think I've noticed the same thing, John. Lately, in 2021 especially, the resistance setup, or the bag holder setup as they call it, hasn't worked as well. And I think there's been more short traps. That's why a lot of traders struggled in the latter half of 2021, and myself included. It was very choppy, and a lot of the setups that we expected to work were traps or were very manipulated. And I feel as though like the organic liquidity in the market dried up, and we had more, manipulation, algo presence, different players in the small cap realm versus before, when things were trading such small volume. They're all just like low volume chat pumps, and they'd have one little spike and die. We were seeing less and less of those patterns. But now in 2022, I think those patterns are starting to emerge again. That's why we haven't had many plays. There's so many pop and drops. And those are the cleanest patterns that I used to make money on with a small account. So I wouldn't mind if those came and made a resurgence. It's just, I think the bear market cycle now has kind of flushed out a lot of these gains and manipulators.
Yeah.
Yeah, and I think like just thinking back to your Gene as well, it feels like we went through a phase of, we'd have 3 or 4 green days in a row, and then all of a sudden you'd have that pullback, pop into resistance, and that's where you get your A plus. Whereas I think at the moment we're getting that big high volume day 1, pulls back day 2, and that's when we're starting to see that liquidity trap. Whereas I think perhaps in previous market, that cycle that we just went through, actually it probably would have been a day 2 green, day 3 green, and then you get your A plus set up a day or 2 later.
Yeah, I think we're seeing a shift in the market, because that SOPA example that I showed you guys was actually a loss. We took a loss on the day 2 because it kept ripping. Whereas today, INDO was a day 2 setup, and it kind of just fizzled out. So we're seeing a definite shift of the sentiment in the market more towards, the short side.
Good stuff, man. Good stuff. Was that another slide you had there at the end that you wanted to discuss?
Yeah, that was the SOPA trade right here. So
Okay.
this table, I mean, we touched up on this before, but like I said, guys, this is where my conviction comes from. And to explain that chart that you showed me before, John, of the Twitter post,
Yeah.
this is the reasoning behind it, right? So people won't see this, the math behind it. They'll just look at one outlier example and extrapolate that and say, oh, what a terrible risk management or what a terrible trade. But that's just one trade, right? It's one probability outcome. You don't look at the other ones where it could be a max win of 30% gain and nobody says anything about that, right? It's quiet.
Yeah.
So it's just the common theme of Twitter that people want to focus on these negatives, but we just look at the entire picture, right? We don't look at negatives or positives. We look at everything that can occur and we just try to quantify that. This table helps us do that.
Fair enough. Yeah.
Chris, how do you feel about putting yourself out there on Twitter? Like, from what I can tell, you're an extremely transparent guy. How does, like, do you feel any extra pressure? Does that weigh on you, or do you just not give a shit and I'm just going to put myself out there and people come at me?
Right. Well, I think when I first started posting on Twitter, it was mostly for myself. Like, I started my Twitter account back in 2017, and it was mostly just to track my own journal. I didn't have any followers. Like, I never expected to have a chat room. I never expected to have a big following. I just posted my ideas, posted my trades, and it slowly grew. And my approach has been the same from day one, guys. I've always had wide stops. I've always been a contrarian. And, you know, you just develop a thick skin over time, I think. And part of me just wants to bring awareness to this side of trading. It's not, you know, one type of trading that you have to follow, or you can question the status quo. Like, common trading wisdom can be, you know, proven wrong. Just ask the right questions and provide the right data. I think a lot of guys just buy into stuff because, you know, a big trader guru or Twitter trader says something, the tweet has 200, 300 likes, and they just accept it as is, as a matter of fact, without questioning it. And that's just been my approach, I guess, my entire life. So that's my theory and my approach to trading in Twitter accounts. I just want to bring awareness to everything. And if people adopt the mentality that I have, then they can profit. You know, a lot of guys in my room are profitable using these strategies, and they'll tell you themselves that, you know, they followed that mainstream advice of buying, you know, breakouts or trading for 2-to-1 risk reward or having all of these ratios, and it didn't work for them. So it just, to me, it's just finding something that works for you and resonates with you and just sticking with it and having conviction in it. This works for me, and I'm going to stick with it. And if other people watching this webinar, you know, are inspired to learn more, that's cool. Do whatever works for you.
Yeah, fair enough. Hey, have you got a little bit of time that I could show the little Kelly calculator you've got on your site?
Yeah, go ahead.
So for those of you out there that that data was a little bit too much, you know, or you know, just to get started, I wanted to show you that that Kris has some really nice tools on his site. So you know, if you want to check out krisverma.com, and under day trading, he does give a great little explanation of the you know, how to calculate the Kelly ratio and or the Kelly criteria, you know, that chart that we saw there. And then he's got a link down at the bottom of that page that takes you to this this Google Docs. You want to tell us a little bit about it there, Kris?
Yeah, so this is actually one of the first Google Kelly calculators that I came up with. And it's very basic. You know, it basically just takes into account all of the metrics that the Kelly Criterion formula uses, which is the win rate, the profit ratio, and then the bankroll, or the Kelly stake is what they call it. And it uses all of those formulas to calculate the expected growth. So right here, you can see the expected growth is 60%. And then it tells you the full Kelly stake, 61%. So it tells you exactly how much of your position or your account to put on the position. So 61% would mean that you should be willing to risk that much on the trade. Obviously a very high number because these metrics are somewhat unrealistic, right? A 3-to-1 profit ratio with a 71% win rate. I don't think anyone can achieve that unless
Right.
you're insider trading or what have you, but it's just a helpful calculator to quantify your setups.
Gotcha. Yeah. And so the full Kelly stake, that would have been the number one on your graph earlier, right?
Correct, but there is another calculation that you have to use. The full Kelly stake doesn't account for your stop loss. So you
Okay.
have to divide the full Kelly stake by your stop percentage to get the stop adjusted stake down below, right? So
Okay.
that's where your stop loss comes into play here. Your stop loss here is 1%. So that's not
That's
really realistic.
pretty
I'd probably
tight.
change that to like 10% or something, and then the stop adjusted stake would change with that.
Gotcha. So if we put that at 10, that would probably change things or not?
Yeah, it would increase the stake size, because if you're only willing to risk 1%, then you can't really use much of a position size, right? So
Got it. Well, listen, it's been an absolute pleasure to have you. Why don't you tell our viewers how they can see you? I know we've got your Twitter profile already, or your Twitter handle down below your video here on YouTube, but how else can they find you?
well, like you mentioned, John, they can check out my website, krisverma.com, or Kris Verma 88 is my Twitter handle. Those are the two platforms that you can find me on. You can email me, DM me, or whatever. You can see one of my posts on Twitter. I'm sure you have.
Absolutely.
Stirring up controversy as always.
Cool, man. Well, what's the game plan for 2022? Just keep doing the same thing. You got any goals?
Well, like I said earlier, my trader resolutions for this year basically just to execute my plan at a high rate. So I've been posting my execution percentage on my tweets, if you guys have noticed. I get a lot of DMs of what this means exactly, and just basically means how well I followed my plan going into the day. So I just want to focus on that, make that an emphasis, because I think in the Twitter community, we're so focused on P&Ls and charts. Nobody really talks about execution. How well did you trade today? And I want to put more emphasis on that for my viewers, my students, and for myself as well. So that's my focus going forward.
Chris, just on that quickly before we wrap up, do you think there's a chance actually you might fall short of that goal of 100% execution? Because from what I've seen so far, I think every day has been 100%.
Right. Yeah, it's been fairly high because that's been my commitment going forward. And, when I set that goal for myself on January 1st, it was, I knew it was going to be a challenge, because it's so easy in the heat of the moment to say something, but 2, 3, 4 months down the line, are you still going to have that same, follow through? That's where we fall off and, lose conviction in our plans. One thing I said, ironically, to my girlfriend, that the thing about resolutions and just like New Year's resolutions is, do you even remember what yours were last year? Most people don't know. So that tells you, how can you even follow it if you don't remember what it was? So that's my main goal, is just to remember what it is and to make a point of it every day to stick with it. So I think I've done a good job. 1 month down, we got 11 more to go.
Well, I think as well, by the time you get to March, that's likely to be a habit, and a habit that's formed.
Yeah.
Which just increases your chances of success.
Yeah, I agree with that 100% as well. So it helps having, those things publicly displayed. So you guys asked about my Twitter account. That keeps me accountable as well. That's why I recommend to my students and my followers, start a Twitter account of yourself. And we've done this in the room. We've created KVS account challenge tabs where every trader, their trades are made public to the rest of the room. So it's accountability so that we can stick to the plan and help each other stay focused and stay on the right path.
Awesome, man. Hey, listen, thanks so much for coming on. It's been an absolute pleasure.
Oh, thank you. It's been awesome talking with you guys. I'm sure we can go for hours.
Oh, yeah.
I was going to say, it sounds like if we want to chat about data, you're the man, and we can go for hours. And I love it.
Yeah, it's
nice chatting with you guys.
Yeah, thanks so
you,
much, buddy. Thanks.
All right. Thanks, John. Thanks, Sam. Have a good day, guys.
Hey, thanks so much for watching. If you enjoy our content, please subscribe to our channel and be sure to like our videos. Also, check out tradingsim.com/blog for more content.